This video will explain how to do a diluted earnings per share calculation. Now remember that basic earnings per share is calculated at the top level within a consolidated group. So it's looking at the earnings for the group that are attributable to the ordinary shareholders of that parent entity within the group. That gives us our basic earnings per share. So with the basic earnings per share, it's really an historic view of what's happened for the last year. Here it's the 30th of June 20x8. My earnings are $1 million. My weighted average number of ordinary shares are 2 million. Therefore, I've got a basic earnings per share of 50 cents. So if you like, try to think of this as we're presenting the good news to our ordinary shareholders of the parent. But what about diluted earnings per share? What are we trying to show here? So our ordinary shareholders will have reported to them in the financial statements a basic earnings per share of 50 cents. But what we're trying to do with diluted earnings per share is to say, okay, what if there are some other sort of holders of instruments? What's going to happen to your basic earnings per share? So that's what the diluted calculation tries to do. So the standard's only focused on bad news. So maybe think that we're trying to be conservative, not trying to show future good news, but only the future bad news. So with diluted earnings per share, our starting point is that we know the basic earnings per share figure. Here it's 50 cents. And we need to think about our instruments that are out there at the end of the financial year that are what we call potential ordinary shareholders. So they could become ordinary shareholders in a future period. So what we do under IAS 33 is that we test each of those instruments one at a time and see what their impact is on the weighted average number of ordinary shares. And we also look at what the earnings impact of those potential ordinary shares are. So let's look at an example with three instruments: convertible notes, preference shares, and option holders. Let's look at the facts for these convertible notes. 300,000 notes were on issue at 1 July 20x7. And they were issued at $5 per note, so we've got a liability of 1.5 million. They can convert to 300,000 ordinary shares if the liability is not repaid in cash. The interest is at 10% on that 1.5 million borrowing, and the tax rate is 30%. So with diluted earnings per share, we're trying to look at what's the incremental effect. So how would things change if they were no longer note holders? What would happen if they became ordinary shareholders? So let's look at the effect on earnings. So we'd no longer be paying that interest expense of 150,000, which we can see there with the tax rate. We would have a tax deduction. So the after-tax expense that we would avoid is $105,000. So that would increase our earnings. So that's why we've added it on there. Plus, on the base, they would become 300,000 ordinary shareholders. So we're adding on to the base. So the incremental effect on EPS is 35 cents. And remember that our basic earnings per share was 50 cents. So therefore, the effect of the convertible notes, if they were to become ordinary shareholders, is that it would be dilutive. So that's bad news for our current ordinary shareholders. So we'll be including those when we do our diluted earnings per share calculation. Let's now look at these convertible preference shares. We've got 400,000 convertible preference shares that were issued at $2 on 1 July X7, and they're classified as equity. They can convert to 200,000 ordinary shares at the preference shareholders option. The annual dividend is 4% per share, so 4% on the 800,000, so $2 times 400,000. The 4% dividend is $32,000 and the tax rate isn't relevant because it's an equity distribution. So again, let's have a look at what this means for our diluted earnings per share. Again, what's the incremental effect? So remember, our earnings, when we do basic earnings per share, is we take the profit and we subtract off the amount of the preference share dividend because that amount can't go to our ordinary shareholders. So if these preference shareholders became ordinary shareholders, then our earnings for EPS would increase by $32,000. Similarly, we can see that they will convert to 200,000 ordinary shares, so therefore our denominator goes up 200,000. The earnings per share effect is 16 cents, so then, yep, it's bad news, so it's diluted. I can do a bit of a what if just to show you a flip side. What if instead they converted to 50,000 ordinary shares? So 400,000 preference shares traded in for 50,000. You could see there the EPS effect would be 64 cents compared to our basic earnings per share of 50 cents. We'd say that they are anti-dilutive. So we always need to test instrument by instrument. So yes, in that case, they would be anti-dilutive. But my facts here are based on converting to 200,000. 16 cents is lower than 50 cents. So yeah, bad news for our ordinary shareholders. The preference shares are dilutive. And lastly, looking at our options. Let's say I've got 200,000 options that are on issue at 1 July 20x7. The options can be exercised for $3 per option. That means the option holders have to pay $3 in order to acquire 200,000 ordinary shares. The average market price of the shares during the year was $4. And again, the tax rate isn't relevant here because options are an equity instrument. So options are a little bit difficult to deal with diluted earnings per share, and we take a slightly different approach to what we've seen with the convertible notes and convertible preference shares. So let's use that information to see what IAS 33 is asking us to do. So remember, I've got 200,000 options on issue. They can be exercised for $3 per option to get those 200,000 ordinary shares. So the options will bring $600,000 in cash into the company for the extra 200,000 ordinary shares that would have to be issued. The average market price of the shares for the year was $4. So if instead the company went to raise on the market 600,000 in cash, then at that average share price of $4 for the year, the company would only have to issue 150,000 ordinary shares. So that's a bit of a what-if calculation. It's as though 50,000 ordinary shares would be issued for free. So the option holders are really getting a good deal because they're buying they could buy their 200,000 ordinary shares at $3 rather than if they went onto the market to buy the shares, it would be $4 per share. So the options, however, for the existing ordinary shareholders are not a great deal. So we have to include these 50,000 additional ordinary shares, so that shouldn't say options, 50,000 ordinary shares in the diluted earnings per share calculation. So the 50,000 extra ordinary shares, you can see there in red, are deemed to be issued for no consideration. So let's put that into our table then. So when I'm looking at the incremental impact on earnings, there's no change because the contribution of the $3, that's equity, that's not an impact on our profit for the year. So no change in earnings, but our weighted average number of ordinary shares, we add 50,000 on there because in effect, the existing ordinary shareholders are giving away, if you like, 50,000 shares for free. So there's an extra amount of shares coming in and for no extra earnings. So therefore we can see the EPS effect is 0 and 0 is lower than our basic earnings per share of 50 cents. So again, what we see is we've got bad news for our existing ordinary shareholders. They are dilutive. So what we then need to do is to rank those 3 dilutive instruments from the most dilutive to the least dilutive. So we can see that the options, because we start with 0, they're the most dilutive. The preference shares were 16 cents, so they're the second most ones, and the least dilutive are the convertible notes. And we use this information to calculate our diluted earnings per share, keeping in mind there that our basic earnings per share was 50 cents. So yeah, bad news happening for our ordinary shareholders. So what we do is we put this information into a table, and the standard wants us to do it line by line. So we know that they were dilutive when we compared with the 50 cents, but we just need to check each time we make this calculation, starting with the most dilutive, which are the options, and heading towards the least dilutive, which are the convertible notes. We add the change in earnings and the change in the ordinary shares to see what happens. So we start at 50 cents, which is our basic earnings per share, and it's dropping down each time. So therefore, each of them is dilutive. We end up with 44.59 cents, or 45 cents if I round. That's my diluted earnings per share. Now, you might think, why couldn't you just pick up the summary values from the bottom of the table and get that answer? Well, in this case, you could. But an example to look at is illustrative example 9. If you want to sort of see why we do need to do this calculation instrument by instrument, because in that example you'll see that although the dilutive effects seem to be below our earnings per share, once we added it together line by line, the last instrument ended up resulting in an anti-dilutive value. So perhaps go have a look at that one. But here with our situation, all of these are dilutive, and what we get is the bottom line is 45 cents is our diluted earnings per share. So our existing ordinary shareholders are notified in the annual report that the basic earnings per share is 50 cents. What we've seen is the earnings have to be spread with those potential ordinary shareholders. If they were to become ordinary shareholders, we're spreading the earnings more thinly across a wider base of ordinary shareholders, and that causes our diluted earnings per share to be lower than our basic earnings per share. So therefore, in the financial statements, we disclose basic earnings per share of 50 cents and diluted earnings per share of 45 cents. So that's how you do diluted earnings per share.